Good morning, everybody. We've got another merger this week, so we're talking to Richard again. But first, I've got a couple of bits of news to run through. And then our guest this week is going to be talking about SDCL Energy Efficiency Income Trust. So without further ado, I just wanted to put up the bankers' results because it's quite a big fund, and it doesn't really get mentioned very much on here. A little bit on that Hipgnosis thing, and then Richard will talk about this merger. So bankers first. It always, as you can see there, used to trade at asset value, extremely popular, performed very well, and it hasn't worked quite so well since rates started to rise and growth started to sell off at the beginning of 2022. And you can see that the discount has opened up there, and still looks like it's sort of trending downwards to me. I mean, they have bought back an awful lot of stock, but that doesn't seem to have helped. The discount's 12.6. It's still a big fund though, so well over £1 billion. And so there might be room to step that up a bit, maybe. In terms of the sector, it's a decent size. It's one of the bigger ones. You can see actually in terms of discount, it's probably one of the widest. It does have this yield element, and that's important to the story. We'll talk about that a bit more. Ongoing charges ratio, very competitive. You know, generally it's quite sort of solid fund, I think, and that again, I'll bring that out. But when you look at the returns here, and you look at the rank of the returns, it's really not great. So obviously every year, 11th out of 13, over 10 years, 11th out of 13, bit better over 3 maybe. And similar sort of story in the share price numbers. And I'll just highlight it because it's a good, Alliance Trust is doing really well actually at the moment, which is cool. I actually just written something about this in City Well, which you can see on Monday. What Bankers is trying to do is to beat the FTSE World Index and grow its income ahead of UK inflation, which is now CPI. So that objective has changed a bit over the years. It was a 50-50 UK world benchmark, which is slightly odd and a kind of legacy from the old days. They changed that a few years ago. And obviously they switched the inflation target from RPI to CPI. Nevertheless, it's still sort of the same kind of idea. It's an AIC dividend hero and a proper one, 57 years now of consecutive dividend increases. And this increasing dividends ahead of inflation has happened. As you can see there, it's only really over 3 years it's slightly fallen behind, but it's playing catch up with this year's 10% dividend increase. So that's a big kind of tick in the box. The whole idea of it, the ethos is very long term. So they say that they're basically looking at what's going to happen in 5 years and further than that, when they're looking at whether they want to buy stock or not and how they're going to position the portfolio. That all makes sense to me. And I say about sort of this area of solidity about it is focusing on quality companies with yields and strong cash flow and potential to grow. So they're quality growth companies, and that area hasn't done so well recently. And there's part of that is they focus on companies that have got a yield of about between 2 and 4%. So they don't buy companies that don't have a yield. Now, the thing that's sort of a real legacy is it's still a portfolio that's run on a regional basis. So this used to be quite commonplace in the old days, but more and more managers said, this is daft. I want to pick the best pharmacy company, regardless of where it's domiciled in the world. I want to pick the best auto manufacturer. Yeah, that sort of approach. This is still lots of different regional portfolios, so 6 portfolios. And that means they've got a relatively high number of holdings. That's come down a bit over the years, but still relatively high. And there's a big kind of UK bias in here, which I think, again, is a legacy from this old 50-50 benchmark. So in the world index, the UK is only about 4%, but this has got a weighting of about 16. And the weighting in North America is almost 2/3, and this is very, very underweight North America. And that's had been a problem. So the results aren't the end of the world. I mean, they're only sort of half percentage point behind the benchmark, but they have now underperformed over 5 years, and the discount, as we said, has winded. And they put the blame squarely on being underweight the kind of Magnificent Seven stocks that you see there, the ones that are exposed to AI. And those numbers, it does all stack up. And I think we're going to hear an awful lot of that. This is going to be a very common excuse as we go through all the results going through for the next few months. So if they went up 64%, but everything else only went up 0.5%. In the wake of this, because of the sort of long-term underperformance, they are thinking about what to do. And the chairman said they're thinking about US non-yielding stocks and whether they can have some exposure to those and maybe use the revenue reserve to achieve that. I'm really dubious about this, and I highlighted this when we read the news story. The manager seems to be saying, on the one hand, that he's never seen markets behave this way since we had the TMT bubble. And at the same time, he's saying we think we should change the way that we run things so that we can buy these stocks, which seems like piling at the top, which seems like a really daft idea to me. I think if you have to pick out where it does make sense to change things, is to look at that regional portfolio game again. I think because of that, they've been very overweight China and underweight India, because China's got its own dedicated portfolio and India doesn't. And that's obviously not worked this year. Obviously, for a long time, the UK overweight's been a drag on returns too, but also UK stocks are cheap, so maybe that's going to become good at some point. I do think that the main appeal of this fund is that it's this quality-focused, boring, if you like, thing. And this is something that the chairman pulled out back in 2013 when this was one of the best performing global stocks. It was expanding, issuing stock. I think it just needs to stick to its knitting, really, but maybe just think about this regional idea. Anyway, so that's me on bankers. Just very briefly on Hipgnosis. We know the story of this one, 50% discount. So one of the things that the board has decided, having talked to shareholders, is that it's unlikely that people are going to bid for either bits of the portfolio or the whole thing, because you can go all the way through the process of doing this, which is all quite expensive, we know, lots of advisors, get to the end, and then the manager's got this option just to buy the portfolio, whatever price you're paying for it, and your bid falls away. So why in that case would anybody go through the motions of doing that? So they want to be able to cover the costs of a failed bid if that failed bid results in the manager buying the portfolio at a decent price and a good outcome for shareholders. So I think it does make sense, this idea. It's a bit strange. I mean, obviously, in an ideal world, we'll just get rid of the manager's call option, but we can't do that. So, but the only way they can do this is trying to enshrine it in the company's articles, just to make sure nobody gets sued for doing this. And so I just think it does make sense. They've got 35% of shareholders backing the proposal. I think it probably will go through, but it's just such an odd thing, and it just comes back to the way this was set up at the beginning, and all the sort of small print stuff that was buried in the prospectus that nobody knew about it, and if it was in there. Yeah, it's just uncomfortable. And we have to just make sure when these things happen that we don't let them happen again. Right. I'm going to hand over to Richard.
Brilliant. Thanks, James. Yeah, so another week, another real estate merger. So this time it's Custodian REIT who are merging with Aberdeen Property Income. This is driven by, well, both boards are recommending it, but it's driven by Custodian. So Aberdeen Property, so API's shareholders will receive 0.78%, 0.78 new Custodian shares in the deal. That values it at 237 million, which is about 30% premium to its share price last night, 26% over its 3-month average, but still quite a sizable discount to its NAV. At the last reported NAV was at the end of September, so I mean we await their end of year NAV. But I don't see it going down too much. So it will be around that. So I mean, make your own sort of opinions on that really, but it still feels a bit short for me. But it will create a company that's market cap of £500 million and a portfolio of just over £1 billion actually. So quite a sizable company if this does go through. Here's the performance in the within their peer group. So I didn't put the highlights on the companies, but Custodian's there. This is 5-year NAV returns. So fourth in this list. I mean, not great returns, but obviously the last 18 months has really hit those numbers. And then Aberdeen Property Income down there in sixth, so about mid-table. But you can see the share price differences. So in the last year, Aberdeen's gone down almost 23%, and Custodian sort of 8%. So if we look at the sort of individual charts on the next slide, so this is API. You can really see this is sort of 10-year chart, I think. So you can see the impact that COVID had. It was doing relatively well before that, and it's never really regained it. And then obviously back in the 20 or halfway through 2022, when interest rates went up, it really got hit, and the discount has just come out massively, almost 43% now, which obviously isn't sustainable. Custodian REIT, similar sort of chart, but not as heavily impacted. So discounts come out to about 17.5%. Difference between the two is that the dividend yield is fully covered with Custodian, and with API their yield is about 80% covered, and that's mainly to do with a refinancing they did. They had to do sort of late 2022. Their debt was coming up to maturity in April 23, so they decided to. Well, they were in the works on refinancing it in late 22, right at the height of Liz Truss's disastrous reign, which obviously saw their rates go up, and that had a real impact on earnings. They did refinance it again shortly after that, a couple of months after, but still way higher than what they were paying before. So that had a real impact on them, and they've been trading at a massive discount for a long time now. So 37% average discount in the last year, 29% in the 3 year for over 3 years, and Custodian has been relatively sort of stable, about 10% over that period. So we look at what could come of the two. So they're fairly complementary portfolios actually. So they're both diversified in sectors and geography, and both look at sort of smaller lot sizes. So these are sort of below what the institutional investors would look at. So they see there's less competition there, and there's more likely to be a mismatch in pricing that they can take advantage of, move rents up and move values up, things like that. So the combined group will have annual rents of 68.1 million, and the estimated rental value, that's sort of an independent valuation on their portfolio, shows that it could be at today's market rates 84.3 million. So there's a 24% uplift potential there, which is obviously attractive. Cost savings would be £1 million a year annually from one set of management fees basically. And then in the first 2 years, Custodian REIT has agreed to cut its management fee whilst sort of this is the transition period basically. So that will create an additional 2.1 million in the first 2 years. And then debt wise, so about 30% LTV, which is comfortable. Like I mentioned earlier, cost of debt has gone up, so that's be about 5% weighted average, and about four years on the maturity. And then just to wrap it up, really, what the sector weightings will look like combined. So pretty similar, like I said. So a focus on industrial, which is good. That's a sort of strong sector with rental growth prospects going forward. It's a bit there in offices, which may be a bit of a question mark over it. But yeah, complimentary. We'll see what happens. Both sets of shareholders need to vote this through, so we'll see what happens.
Yeah, there's a question here actually, because they're saying that Custodian REIT shares apparently down 11% this morning.
Yeah.
I guess that's kind of merger arbitrage going on a bit. But what I'm not really seeing here is what the sweetener is for Custodian REIT shareholders. As maybe is it that they're buying the API portfolio on the cheap?
Yeah, it's on the cheap. API is a client of us, so I write on them quite regularly. It's a really good portfolio. The manager's really good track record of buying decent property, finding these mismatching prices basically in the regions, and putting asset management initiatives through it to increase the value. So yeah, I see what's in it for Custodian. They're getting a good portfolio there at a decent price.
Maybe somebody else will come along and make a counter bid. That'd be good.
Yeah.
We shall see. Okay, cool.
Thanks.
Thank you, Richard. That's the end of our news bit.